We are having this special chat with Sanjay Shah of Morgan Stanley from the sidelines of the Morgan Stanley's 21st India Summit. Sanjay, thank you very much for your time and joining us on ET Now today. I was really looking forward for this chat.
No, thank you for inviting.
Sanjay, let's sum up the conference this time round. What is the key takeaway from the conference? What did you measure? How did you measure the sentiment in your clients on eagerness on India? What are thoughts there?
So look, I think the mood is more somber this time around than the previous two conferences. And in some ways it's good because there is a realization amongst the corporate as well as with the investors that the economy has slowed down. Earnings have not yet come through, and in fact most of the high frequency indicators also indicate that the softer patch may last for a longer period of time. And the backdrop is against a very difficult global environment right now. And there is a trade war between US and China. The global economy is slowing down. And that also makes it a bit difficult because at the end of the day, there is a reasonable amount of exports that we depend upon. The good thing out of that is that oil prices are down globally as a reflection of the slowdown, and interest rates are coming off everywhere in the world. In fact, the Fed fund futures are already discounting about 70 to 80 basis points of rate cuts. So that also provides in some ways more room for monetary stimulus in many countries, including India, particularly against the backdrop of a lower oil price. So in summary, the mood is somber. There is a realization there is a slowdown. At the same time, as compared to many other large economies in the world, India possibly offers a more attractive destination for overseas flows.
Sanjay, in this kind of an environment, the expectations or the needle of responsibility moves towards the policymakers big time on what kind of urgent needs are required to be taken. What are your expectations? We just have a new cabinet in place, a government is in place, which is a stable one. People may be taking observation, a new finance minister, budget lies ahead. What are the areas do you think, in your view, they can move towards addressing first, among others, which can at least change the mood a bit, or at least sends a message in the corporate India or in the economy that the government is moving swiftly to arrest this slowdown?
So look, I don't think there is any way in which the government can move swiftly to arrest a slowdown. We'll have to kind of let time take its own, they will have to take their measures that they do and allow time to pass before the slowdown kind of gets arrested and we see a gradual pickup. The good thing though is that we've got policy continuity. The mandate itself is strong and we have the same government coming back to power and if anything a more powerful cabinet. So hopefully, and not just hopefully, surely the impetus to infrastructure investment. Remember, they had almost $500 billion of investments done in infrastructure in the last 5 years, and they got a manifesto of almost $1.5 trillion. So obviously, the first thing is that focus on the unfinished project. The work in process will continue, and these projects will get executed. That will be in the metros, that will be in railways, that will be in airports, ports, so on and so forth. Right, and that hopefully will lead to more confidence amongst the private sector also to do more capex. Again, it's going to be over a period of time. Moot point is policy continuity, more focus on infrastructure, obviously a focus on the rural economy because that is in distress, and the Prime Minister and the policymakers have spoken about it even before the elections, and that is going to continue. So I think that's really how one should summarize. The key is that in the last 3 to 4 years there was a greater focus, rightly so, on fiscal consolidation, and at this point in time I guess the investors as well as the corporate would prefer not to compromise on the macro fiscal consolidation, but at the margin give more priority to growth initiatives.
So out of the plethora of your clients which came in both from the domestic fund community and the FII side, how are you sensing their approach to the market in terms of deployment to assess the possibility of flows in this plus and minus kind of environment which you have painted for us, right?
So first on the flows, right? Last year was difficult. And it was difficult because of a variety of reasons. Valuations were expensive, earnings growth was not coming through, and more importantly, earnings had not got recalibrated down. And I think the first stage of a slowdown is always going to be a state of denial. And then there is an acceptance, gradual acceptance that there is a slowdown, but manufacturing doesn't slow down, inventory levels get pushed up. And then finally everything gets right-sized, the balance sheets get right-sized, the corporates start focusing more on working capital and cost optimization. So I think we are in the process of, or rather we are going through all of that right now. So that's good. And to that extent, and also because of the strong political mandate, already the flows from a portfolio perspective have started accelerating. In fact, this year we've already seen more than $10 billion of inflows coming. come into the country. The second thing is that because of what's happening in the world, and we spoke about the US-China trade war and the challenges that the global economy is facing, on a relative perspective, India does offer a better macro story. And that's the reason why I suspect it won't be in torrents, but will gradually, or rather will continue to see flows come into India gradually.
So last time around when we saw rate cuts globally, we saw a lot of fund get positioned towards emerging markets. What probability would you assign that on the fear of recession or sharp slowdown in US, if Fed goes ahead and starts cutting rates sharply, like some of it is getting factored in now, it will get an added boost to flows towards emerging markets, and out of emerging markets, because India is well positioned, we may have a fair share.
So that's a bit more complex, and it's a bit binary also. If the US-China trade talks fail and more duties are imposed upon Chinese goods, then we will see the economies in the world slow down significantly. Our base case is for a global GDP growth of 3.2%, but if this uncertainty between the two countries continues, the world economy can slow down to around 2.7%, which will be very close to a recessionary level. Now remember, so long as there is a slowdown and the Fed takes adequate steps to provide stimulus in the form of rate cuts, emerging markets could benefit. But in the event of a slowdown, emerging markets would never benefit, and there would be collateral damage, more so on risk assets, and emerging markets are a part of the risk assets.
Sure.
So it's a bit binary at this point in time.
You also had a very good mix of corporates attending, like always. If you could share some insights out of them, what were the FMCG guys saying in terms of costs? What were the automobile or manufacturing guys telling you about the kind of slowdown they are factoring in? Because a lot of people are questioning, say for example, a company like Maruti couldn't gauge that a sharp slowdown lies ahead, that they had to go ahead and adjust production for 4 straight months in a row. It was so sudden, some people are raising a point. So what did you gather from different sectors representation in your conference this time?
So I won't talk about a specific company, but I think it's fair to say that the first stage of slowdown, corporate as well as investors and possibly policymakers were in a stage of denial. And then once the slowdown started kind of hitting, we still thought it was going to be a very short-term slowdown and the economies would get stimulated again. And that's when the manufacturing continued at its own pace, inventory levels started rising again. On top of which we had these issues with the NBFCs, and financing got restrained, and the slowdown possibly in the interest rate sensitive sectors, particularly in discretionary, got impacted even further. Right? So we are, I think, going through that adjustment phase, and corporate, when you ask me about them, there are 2 kinds of corporates, ones who respect the cost of capital, ones who do not. The ones who respect the cost of capital are really busy internalizing and preparing for the eventual next cyclical or structural uptick in the economy. In the meantime, they're tightening their working capital, they're tightening their cost, optimizing their processes, and just making sure that they become more and more efficient about it.
Also talk to me about, say, for example, I was just reading your commentary earlier. You are making a case that there is, one should be looking at, or positions should be made towards domestic cyclicals, because the environment is such that global cyclicals obviously may not do that well. But if you look at the domestic cyclicals, the sector which come to fore are industrials, some capital goods, automobiles, interest rate sensitive. How do you rate them in terms of priority, and the business case is stronger there in the current environment?
So look, our strongest preference is for the large corporate lenders. That's in the private banks as well as the large, 1 or 2 of the large state-owned banks. And that's really our focus, because we've seen one of the most challenging NPL cycle in India over the last 4 to 5 years. In fact, impaired loans peaked out at around 12 to 14%. Now they're back in single digits. The credit costs for the large corporate lenders were in the 250, 300 basis points range, and they're coming down quite significantly, at least as per our forecast. At the same time, they're taking share away from the inefficient state-owned banks and the non-banking finance companies, many of them at least. And we will have a very interesting combination of credit growth being concentrated with the large corporate lenders, even if the overall system doesn't grow, the NPL cycle receding at the margin for the banks at least, and the credit costs coming down. So an acceleration in pre-provisioning operating profits. So that is our big call, and it has been for some time now, for a few quarters.
It has worked in
and it's worked extremely well. Other than that, it's really about select companies in different sectors which are available at reasonable valuation adolescents. And it's not really sector specific, but industrials and infrastructure look good given the kind of policy continuity we expect and the focus on infrastructure that the government has always had.
No, because the BHE and L&T commentary, the quarter result gone by, has been extremely strong, and they can be seen as good representation at least for the capital goods sector. So probably, is it okay to assume that because their client lie in all kinds of sectors, that the capex cycle is kind of moving ahead?
So look, I don't think it's fair to paint the canvas with one brush. It's individual companies and specific companies which are doing well, which are in the right segment and which have possibly shown leadership over a period of time. But yes, I think it's fair to say that at least in the infrastructure side and in the entire food chain, including capital goods, we should hopefully see better performance. It's going to take some time. There's no instant gratification out here and there's no quick fix. But I think that's really the right direction. And also in the companies which are exposed to the global cycle, there are a reasonable number of companies which are again trying to get more and more share and succeeding in doing that. But overall, I think our preference is more towards the domestic economy than the global.
What's your view on materials? Because cement space is also showing good volume growth, come back to some 9-year high levels. What are your thoughts on materials as a space?
So look, I think it's the infrastructure food chain, and to the extent that there's going to be more and more, hopefully, government expenditure in the initial few quarters and private capex, which will come in hopefully with a lag as capacity utilizations are going up. So materials which are focused on the domestic economy, which includes cement, should do well over a period of time. Again, the cement companies have had this unique advantage of having the return on equity, most of them, at least the large ones, are significantly above the cost of capital. And they are able to grow with their own cash flows. So that should be an interesting sector.
Sure. What about autos? How are you analyzing the entire spectrum of autos, be it two-wheelers, be it leisure two-wheelers, or even the commercial vehicle companies and the passenger vehicle? Because each of them have different markets. Two-wheelers are being seen as a rural play, but haven't not done. Some of them are global-oriented two-wheeler companies in India. And also a view on how deep is the slowdown which they are facing, which perhaps could be triggered by NBFC as well, but now has set into the overall economy. So
in terms of the slowdown, we'll have to wait and see how much stimulus is provided by the government, right? Because we believe there is not much fiscal latitude to provide stimulus. So stimulus, if any, will have to come through monetary measures. And the Central Bank of India has, again, of course, after cutting rates thrice, has turned more accommodative. So it's fair to expect, at least on our part, we expect 2 more rate cuts. So we're going through this kind of a transition period and a consolidation period for many of the discretionary stocks, companies which includes two-wheelers and automobile companies. The performance might not be up to the mark over the next 2 quarters, but then again the relief is that now at least people recognize the fact that there is a slowdown. So I think we'll have to wait it out for a couple of quarters, but hopefully beyond that they should do well.
On the point of rates, interest rates, there have been 3 cuts. And the stance from the RBI governor is clearly quite dovish now. But at the same time, we had a recent analyst meet of HDFC Bank, where Mr. Puri has clearly said that transmission is becoming difficult for players like them. And now we hear that though the rates are being cut at the top level, the transmission is much slower and coming with a lag. How do you analyze the situation? Have you seen it in the past cycles as well? And eventually what happens? Do people or consumers and companies also start benefiting from lower rates going forward? Or?
So there are a couple of problems out here. One, on the transmission mechanism, it's fair to say that the transmission has been slower this time. But part of the problem also is that the liability franchise and the credit deposit ratios of the larger banks is significantly higher than what it might have been in the past cycles. And that's also understandable because what has happened is that a greater share of the lending responsibility, so to speak, lies with the larger corporate lenders. In some ways, it's a great opportunity because as we start seeing the deposits also aggregate towards the stronger players, they should hopefully be able to grow much faster over a period of time. But transmission, by the very nature of its definition, takes time. And the central bank has also said that it does take a few quarters for the transmission to take place. This has been compounded further by the NBFC crisis, or at least challenges, if not a crisis. And as that plays out, and it's not very clear how that plays out, hopefully we should see all of these things falling into place. The good thing, though, is that as compared to what we had over the last 6 to 9 months, crude prices have come down, oil prices have come off, and to that extent, our ability, or rather at least our ability to right-size the sovereign balance sheet has increased considerably. And that should also play out in the form of consumer demand over a period of time. Remember, the biggest borrower in the market is the government, right? And to that extent, the transmission takes even more time. Once crude prices come down and our ability to manage the current account improves, we have got more flexibility on that side. So that would hopefully also accelerate the transmission mechanism.
Sanjay, you've seen so many cycles in the last over 2.5 decades in the market. Where are we right now in the Indian markets as well as the Indian economy in the stage of the cycle? Say, if you turn back the clock a little bit, we've already doubled in the last 5 years almost when Mr. Modi was named Prime Minister candidate September 2013 too. And now a lot of positives and the promise and the benefits of good policy, steady policy, all of them are being discussed, so probably in the price as well. From here on, and of course earnings last 2-3 years have been continuously coming down. Where are we in a mature market right now? Are we going through a kind of a corrective phase in an overall bull market? How do you see the script play out on a broader scale of things?
So look, I think for a country which has a GDP size of $2.7 trillion, but just at $2,000 per capita GDP, we are nowhere in a mature market. There is enough scope for growth in almost all the pockets of the economy. The difference this time around, and not compared to the last 1 or 2 cycles, but over a period of the last 2 to 3 decades, is that India is more closely integrated with the global economy. And to the extent that there is a slowdown in the global economy and there are challenges to the global economy, India cannot remain immune. We are in a world which is globally connected and integrated. The second difference is that unlike 20 years back or even 10 years back, the forces of disruption are accelerating. We earlier thought disruption was about e-commerce and technology, but you talk about manufacturing, you talk about services, you talk about almost any aspect of our life and of corporate India, there is disruption happening, right? And to that extent, disruption does lead to deflationary forces also kind of occupying center stage. So that is another challenge for corporate India. So it never is the same. It's always going to be different, and this time it is different.
So there's also a chatter in market related circles that India actually, if plays well, then can be a beneficiary of US-China trade war in terms of providing high quality environment for large manufacturing bases which may relocate to alternative locations like India. Do you agree to that? And if yes, which could be the sectors where you could see that capital flow in here?
So I think manufacturing in India has been challenged, but the first step towards resolution is recognition, right? And we do recognize that fact. In theory, yes, India has a great opportunity to take manufacturing share away from many large economies, including China. But for that, we need to make sure that we have labor reforms, we have administrative efficiency, and the myriad of, or rather the complexity of getting approvals needs to be simplified. Which is why I think this time around, more than any other time in the history of the last, I would say, 3 to 4 decades of capital markets and corporate India, policy continuity was going to be the most important thing. And now with the government coming back to power, they know exactly where the pain points are. Maybe 5 years was never going to be enough for them to finish the agenda. So now that they've come back, they can get back to kind of finishing the unfinished agenda rather than spending the next 2 years again trying to figure out what needs to be done. So hopefully it will take time. Again, I think as capital market participants, we kind of start expecting to have instant gratification, but all these things take time. There is an opportunity, but there's no guarantee we seize it. We will need to work towards it.
So in the meantime, do you think a lot of large investors would position themselves into defensive side of the market, may large cap IT, select pharma stocks, or the overall the business models which are seen defensive? Do you think there is some amount of caution in the market setting in, and hence people are hiding behind those kind of select names?
So look, I think the largest exposure that investors have is towards the financials, and financials by their very nature can never be defensive, right? So I think that's really something that we need to take into cognizance.
But corporate banks, don't you think is getting a consensus kind of a large corporate banks are becoming, because they have worked well?
Well, in some of this, we realize that the domestic positioning is the most underweight that we have seen in a long time. And overall, the India overweight, if you leave aside the banks for a moment, which was at the peak about 800 basis points, has come down to 200 basis points. So clearly, India has lost a significant share of incremental flows into equity markets globally or in emerging markets over the last 2 to 3 years. So if one were to believe that there could be some middle ground where maybe we don't go back to 800 basis points, but maybe if we go back more up, then the most obvious destinations for the foreign flows to come in could be the banks as a macro play on India, especially the more efficient banks. Again, it's not the entire banking sector, but at least the large corporate lenders. So we could possibly see that happen. Look, the other sectors, it's a bit difficult. It's really not easy to classify all the companies in the sector into one basket and think that they will get money or they will not get money. It's going to be really individual companies. But again, going back to my first point, it's not about individual sectors as much as it is about companies which respect the cost of capital and which have consistently proven that they can earn returns beyond the cost of capital. And that's where I think the interest is aggregating.
What's your view on large, very nice, diversified consumer companies which historically have been trading at a premium? Lately, their premium have suddenly got a little, crunched a bit, because historically they have been FII favorites. And also, how are you analyzing the commentary from some of these large consumer companies in India lately?
So I think as far as consumer staples are concerned, we've seen there's a slowdown, and there is an acceptance of the slowdown, which is a good thing. But the valuations are expensive, and they've always been expensive, but they're much more expensive than they have been in the past. So I think that's where at least we are a little bit circumspect, not on the companies or on the performance. These are great businesses, just from a perspective of valuations. On the discretionary side, there are companies which look interesting even now, but overall I think they are kind of their fortunes are intertwined with the economic environment and the interest rate environment. So we believe this is going to take a little bit more time.
What are your thoughts on mid-cap end of the market right now? The kind of mid-cap which you guys track, even those, a couple of $1 billion kind of companies.
So we don't track too many of them, but the ones we track have probably much better governance than most others. So on the mid-cap side, two observations. One is that the mid-cap sector as such has not become cheaper. If anything, the stock prices have come down and the earnings estimates have also come down. But within that, the ones which have got stronger governance standards, I think those will do better over a period of time again.
You're also somebody who has really seen the evolution of corporate India. A lot of these companies who are now attending in your conferences and giving speeches are multi-billion-dollar companies, but 25 years back you've seen sub 500 million as well. And right now there's so much of focus of the market in assessing the quality of books, quality of corporate governance, the leadership in the company. How important it is in each cycle for investors to associate themselves with the right kind of company, because accidents can really take a lot of return out of your overall performance, even if it is on a 5-year basis. Your thoughts on the stuff which is happening?
There's one thing I've learned, we never learn. Okay. Right? So at the beginning of every cycle, people are quality focused, and as the cycle progresses and improves further, we kind of lose the discipline and start getting a little bit more adventurous, which works great for some quarters, for a couple of years, for a few years, and then it's back to again the quality bias as the cycles slow down and accidents happen. The one unfortunate thing about India is that after so many years, again, it's really a handful of companies that the large global investors focus on. We have had new listings, many of them, but we've not really had new listings which have come of size. The last time the index itself got disrupted was in the late 90s and the early 2000 period. So I think with the kind of activity which is happening on the private side, on the sponsor-related side, sovereign funds are investing, pension funds are investing, private equity funds are investing. It's a bull market happening in the unlisted market.
Yes, that's
right?
correct.
With
record number money
with almost $200 billion invested in the last 10 years. And as these companies grow in size with some really strong governance provided by many of the sponsors, and they get listed over the next 5 to 10 years, I think that's going to be the exciting phase for India. In my reckoning, the index as it exists right now will just completely get metamorphosed in the next 10 to 15 years. A new set of exciting companies will come through, they will grow in size, and the investor positioning will also change significantly.
Great, Sanjay. Always wonderful for us to cover your conference and chatting with you and all your colleagues. Thanks very much for your time today as well.
No, thank you very much. It's good to be here.
Thank you, Sanjay.